Good afternoon, ladies and gentlemen. My name is Dmitry, and these are my colleagues, Evgen, Eugene, and Valerie. Today we are glad to present to you our research of Buyer AG, which is currently being traded on London and Frankfurt Stock Exchange at a price of 115.85 euros per share. We initiate the coverage of Buyer AG with our buy recommendation based on a one-year target price of 122.2 euros per share, offering 3.69% of upside potential.
Bayer AG is a multinational pharmaceutical and chemical company based in Leverkusen, Germany. In 2015, the company has started the process of reorganization. The purpose of this process is to scope on the life science strategy. The very first step on this way was the company's division of material science subgroup into separate enterprise called Covestro and selling 31% of the company on the IPO. The second step was a list of acquisitions, the most significant of which was made to improve the positions in the pharmaceuticals, buyout of the Merck's healthcare business. The company lifted up to the second place worldwide on the RTC pharmaceuticals market and improved its positions in the America, the most powerful market in the world pharmacy. The company generates 25 of its 32 billion euros of revenue with the production of the drugs. And if we take a brief look at the company situation, we can see that it has aggressive strategy and provides a predatory strategy.
Since Bayer AG has started the implementation of their new strategy, it now operates only in two global markets, pharmaceuticals and crop science. First and the biggest one in terms of Bayer is pharmaceuticals. It is $1,039 billion market that is in the process of big changes. For emerging markets, it's the 21 developing countries that has already occupied 28% of the world's pie. They grow annually by 13%, and it leads to the change of the focus of producers to such countries as China and India. The negative side of these markets are poor rights protection, generic preferences of the customers, and cross-sectional differences in demand. The only one country from the developed world that has a comparable pace is the world's biggest market, US, with its 12.5% CAGR. Another one important global trend is the expansion of oncology. It has already become the biggest segment and continued to grow by 14 and 9.5% in developed and for emerging markets respectively.
Crop protection is the second division of the life science strategy. This market is very tightly bonded to the global economical situation, and despite the stagnation during the last years, it has recovered and achieved the CAGR 7.5 annually. The main driver of the demand on this market is a world growing population by 80 million annually. And by year 2050, the amount of the farmland hectares per capita will fall from 0.2 to 0.15. If we scope on the company situation among the markets, we can say that the company is very highly protected. First of all, it has a lot of niche specified products that are usually substituted by the brandless generic products. And the second part is that the entry barriers of the company's markets are very high. To launch a new product, it usually takes about 12 years of research and development and about $1.5 billion for one product. However, the company is not a leader or even a runner-up on the market. It occupies only 13th place by the number of the products in research and development and the 9th place by the revenue. But what makes a company a standalone is the fact that the 5 top sellers of the company generate only 20% of its income, which is in fact a huge factor of the diversification.
The market capitalization of Bayer AG is 95.8 billion euros. Taking into account the global strategy of the company, we derived revenues for all major regions. According to our research, their total revenue is anticipated to grow by 8.1% CAGR till 2019. Both net margin and operating margin also show positive trend. The buyer's return on equity is anticipated to increase up to 20.8% till 2019. The total asset turnover and profit margin are sources of total rise, which is a very positive signal for company's management. At the same time, the financial leverage declines, so the company tends to become less sensitive to financial risks. We also forecast declining debt position, which means high solvency level for the company, despite its significant increase in long-term debt in 2014. Thanks to its strong cash-generating capabilities, the company is able to sustain financial flexibility, which allows Bayer AG to new investment, to decrease its long-term debt, and increase the dividend payments to the shareholders up to twofold in the next 5 years. Based on this financial analysis, we will also introduce you the evaluation.
We applied discount cash flow and multiple analysis. Our DCF is based on the sum of the parts for different countries. We estimate cost of equity by using capital asset pricing model. Betas were calculated for running multiple regression for different time periods, and terminal growth was calculated by Gordon growth model. We do believe this is a reasonable approach and obtain the value of 126.98 euros per share. Looking now at our multiple analysis, Bayer AG can be compared to the following competitors: AstraZeneca, GSK, Novartis, Novo Nordisk, and Sanofi. Using EV to EBITDA multiple median, we obtain the value of 117.42 euros per share. Looking at the whole Bayer AG group, we notice the absence of truly comparable companies, since most of the closest peers have different PE rates, EBITDA margin, business and geographical exposure. Our forecasted price is based on the average of both approaches and resulted in 122.2 euros per share, which actually confirms our buy recommendation.
Our target price could be affected by the list of risk factors. Taking into account industry trends, information from Bayer's last reports, the nearest past and expected future events, we created our risk matrix. The most significant as well as the most probable risks are associated with the intellectual property. Among them are expiration of patents, loss of property rights, and generic competition. We noticed that almost each 9 of 10 patents will expire within the next 5 years, which can lead to the patent collapse and up to 80% loss of the market share to generics during the first 2 weeks. Another fact is that advertising boost of competitors can reduce our expected sales of key products such as Xarelto and Eila. One more pair of important risk factors is failure in R&D efforts and regulatory requirements. Particularly, failure in Finerenone in phase 3 can lead to the undesirable results. We can conclude that for every risk factor we came up with a mitigation strategy, and think that Bayer AG follows these tactics pretty successfully. And in general, all our considered risks are common to the industry and will not affect our target price drastically.
So if we can take stock for a moment, the Bayer AG has a really aggressive competitive strategy on the stable market with a focus on the core business, which allows it the prospective financial position. So after deep financial and market analysis, we initiate coverage on Bayer AG with a buy recommendation based on a 1-year target price of 122.2 euros per share. Thank you for your attention. Now we are open to your questions.
What assumptions were used